One thing that you touched on in one of your last podcasts, I believe, and I'd love for you to expand on this, is California and this wealth tax that they're proposing, this 0.4% on, I think it's over 30 million, but in my opinion, that's going to come down and the tax is going to go up like most taxes, but it's retroactive going back like 10 years or something like that. So, I mean, let's talk about that a little bit and try to figure out who in their right mind would stay in California right now if you know the government can come back and tax you going up into 2030 or beyond.
Well, that means if they get away with it, even the people that were smart enough to leave a few years ago are not out of harm's way yet.
Yeah.
But number one, I think the fact that California is even suggesting something like this, to me, that's enough to just go nowhere near the state. I mean, don't even think about living there because it may be one of these things, you know, where it's the Hotel California. You check in, you can never check out. In fact, I joked on my podcast, I would be afraid to go to college in California or certainly go to law school or medical school, because what they're saying is if you accumulated the wealth while you lived in California, we have a right to tax it even after you leave California. Well, if that theory holds, they could just as easily say, hey, you got your law degree in California, so we want a piece of everything you earn as a lawyer. You know, you got your medical degree in California, so we own you. You know, we want to get a piece of what you earn as a doctor. So I wouldn't even go anywhere near California. I'm glad I got the hell out of there myself in 2005. So I don't think they could go all the way back then and try to tax me, because it's well beyond that 10-year number, which is also arbitrary. I mean, how'd they get 10 years? But I think the fact that they're trying to do this shows that they realize that they're driving people out of the state. And so they're trying to figure out how to tax people who not only leave in the future to escape the higher tax, but who have already left to get out of the taxes. But, and yeah, you're right. The threshold is going to come down from 30 million because they're not going to get a lot of revenue. So they're going to bring it down to 20 million or 15 million. But then inflation is going to push a lot of people up. A lot of people that have $10 million net worths might find that they have $20 million net worths, but they'll be poorer because the prices will rise more than their net worths. But inflation will end up pushing a lot of people into the wealth tax bracket. But of course, the wealth tax is going to be very expensive to comply with because every single year you have to hire appraisers to figure out what your stuff is worth, because they're not just taxing publicly traded stocks where you could just look at the closing price and, you know, multiply it by the number of shares you have. They're taxing interest in privately held companies, which you don't know what they're worth because they're not trading.
How much is my YouTube channel worth? How much is your podcast?
Yeah, I don't know. You got to have to go figure it out. And then you have to figure it out every year. And, you know, what if you own some art? I mean, what's, you know, what is each painting that you have worth? What about if you have an antique car? You have, you know, you're supposed to add up everything that you have. The only thing they're exempting is your real estate because you're already paying a property tax there. So for now, they're not going to try to, you know, tax you again on the asset that they're already taxing you on. But for me, it would be terrible because I have so many interests in privately held companies, you know, valuing those things. And of course, they're not even liquid. So, I mean, you're going to pay taxes on something that doesn't even have any liquidity. And remember, the taxes every single year. So if it's 0.4%, that's every year. So it's year after year after year. So after 10 years, that's 4% of the value of these assets that you've paid in taxes, assuming they don't raise the rate, you know?
Yeah, and I think I remember you outlining, this was probably 6 months ago or so, on one of your podcasts, how the income tax started in 1913. And everyone thought, oh, well, it's just on the rich, so it's a good thing. And then sure enough, by 1918, because of World War I, it went up on the rich. But then in the 1920s, it was still very high. But then I believe it was throughout the 40s and the 50s, the income tax on the middle class went up even higher than it was a percentage than it was going up on the rich. So the bulk of the increases in income taxes actually came from the poor and middle class, if you look at the whole span of the income tax.
Oh, I mean, it's a classic bait and switch camel's nose under the tent. The government duped the public into thinking they were going to soak the rich. And in fact, if you go back to the populist movement, the reason that the income tax was supported was because it was supposed to actually be a trade-off for tariffs.
Right.
Because before the income tax, pretty much all the money that the government collected to run on came from tariffs. And contrary to what Donald Trump says, everybody knew back then that the middle class paid the tariffs because it just increased the price of the goods they were buying. And so it fell more heavily on the middle class and the poor than it did on the rich. And so the idea was, hey, if we have this income tax on the rich, we can get rid of the tariffs on the middle class and the poor. So that was why the middle class was so in favor of it. It wasn't that they wanted to soak the rich so much, is that they didn't want to pay the tariffs anymore. And this was a way out of the tariffs because they had to shift the cost of government to somebody else. And so that was the promise that the government made. And that's why the income tax was supported by the people. And then when the Supreme Court originally struck it down as being unconstitutional, the Supreme Court was vilified as, being in the pockets of the rich. They weren't for the common man. But then, they eventually amended the Constitution to kind of get around the Supreme Court and get around the Constitution. And initially, yes, the income tax was 2%, 3%, 4%. I think there was an initial call to limit it. They wanted to put a cap on it of like 6%, which I wish they'd have done. But they kind of voted it down because they were saying, well, if we put a cap at 6%, they might actually raise it that high. So they should have just made the cap lower, but instead they didn't have a cap at all. And they didn't waste time. As soon as World War I started, they jacked up the rates. But by the time World War II started, that's when they really clobbered the middle class. Yeah. Because in 1940, not even 10% of Americans paid the income tax, even with the changes since 1913. But in 1942, they created the withholding tax. And now all of a sudden, better than 33% of Americans were now paying the income tax. And the rates they were paying were much, much higher than the original rates that applied to Vanderbilt, Carnegie, Rockefeller. So in the end, Americans now, we've got the tariffs back under Trump, but we've got tariffs and we got an income tax. And the middle class, again, is paying rates that nobody would have even conceived of imposing on Rockefeller back then. So, you make a deal with the devil and this is what happens to you.